gentlemen, my name is Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of Chicago wheat and corn. I'll start with Chicago wheat. In some ways, this past week has been a waste of time, and in some ways it has not. I'll explain what I mean shortly, but first, one of the significant recent activities here had been the late August break higher above the July to August upper bear channel line. In the process of moving higher, prices formed an ascending wedge pattern, currently 1020 to 1155. This carried on higher until in late September, when the market's rise met a resistance that it could not overcome, despite trying for 4 weeks. This was the important slowly rising long moving average, currently at 945, which at times coincided with November 2012 high at 930. This moving average was breached, but did not have 2 consecutive closes over it at any point in its testing. 3 weeks ago, at the high water mark of the market, prices turned down for a very interesting weekly key reversal down, heading lower, down through the lower trend line of the ascending wedge pattern. The market dropped below some significant supports, but it was only 2 weeks ago at the slowly rising short-medium moving average, currently at 869, that we found the beginnings of some support. Last week I laid out what I thought might be the possibilities here for the future, and I quote, "There are now 2 avenues that I can see for this market, though there are no doubt more available that will eventually make themselves known. The first is a straightforward move down with potential targets for the ascending wedge pattern. Thus a primary target X on the downside has already been achieved in the 860 area, whilst the secondary harder to reach target X1 is way down below in the 712 area. This leads to the second avenue, and something that I had previously mentioned on a number of occasions. It is the possibility for the whole of the July to date action being not just a V bottom, but a V bottom with an extension. These extensions have something like a bull flag within them, and that is what we may be being built since mid to late August. Personally, it looks a little slack as a pattern, but if the short-term moving average manages to hold the market up, which so far along with the November 2012 low at 843 it sort of is, and we then eventually see prices revert back up, well, then this second scenario, the larger V bottom with an extension, suddenly looks a lot more interesting." End of quote. This leads back to my earlier statement at the start of this commentary. This past week has been a waste of time, and in some ways it has not. You see, the early part of this week saw the beginnings of an up leg in a possible V-bottom pattern with an extension. In this case, more a slack bullish halfway hesitation than a bull flag. But the reversion back down midweek countered that move, or so it seemed. What it did show was the continuing bearish influence of the overhead long moving average. It is still a strong force. Additionally, yesterday's move below the short-medium moving average and the halt ahead of what increasingly looks like a strong support, the November 2012 low, with today's small reversion back up, well, that shows that the support below is also still good. So we know that these 2 congestions, one above and one below, are still good. We have learnt that again. But apart from that, we haven't learnt anything new. We, for example, still are not sure if the V bottom with an extension is true. It still looks it, but nothing this week has helped or hindered that idea. Chicago corn. Here are some of the key elements from my comments formed over the last few weeks. The first element is the reverse head and shoulders pattern over July and early August. It has turned out to be a good one, especially the slightly optimized neckline, currently at 699. That had until recently been incredibly supportive, since the market broke higher over it back in late August. The primary target for the reverse head and shoulders pattern has already been achieved, and for the moment I'll retire the secondary harder to reach target in the 714 area. Secondly is the impact of the slowly rising long moving average, currently 692. This had earlier tried to cap the market, but as is separated from the 50% Fibonacci line of the September 21 to April 22 move at 661, its efficacy as resistance faded with the market moving up through it. Interestingly, this week it has become both support and resistance, as well as an indicator of the very recent bullish angle of attack. Finally, and most important of all, there is the July to date ascending wedge pattern, currently 724 to 760. This is the one highlighted in red, trend lines for ease of use. I'd personally found this to have been the most elegant of all the elements. 2 weeks ago, the market exited this pattern. The reason as to why we've seen this exit from the ascending wedge pattern in the first place was because the market has been getting squished in between all of the following. The overhead congestion area, 694 to 700, containing the neckline, the old March to June head and shoulders top, currently at 699. The long moving average, plus the neckline and reverse head and shoulders pattern. And importantly, earlier on, the lower trend line of the ascending wedge pattern. This situation had reached its cusp, and we're now looking to see if the market pressure to seemingly go low will make itself evident. If it does, then the primary target X for the break below the lower trend line of the ascending wedge pattern, assuming it is a true and not a false break, the primary target X would be in the 648 zone, with a secondary harder to reach target X1 in the 550 zone. There's also a possible question of a very large V bottom or bearish halfway hesitation pattern, but I think I'll leave that for another time. So we come to this week, and what added details can be added. Well, we've not really gone anywhere, but that doesn't mean we haven't any additional data. There are two factors to now add to the mix. Firstly, the gapping high on Monday is not as high as the earlier high in October at 711.75, nor is it really as high as the congestion high seen that same week around 706, 707 area. This could be seen as a possible bearish influence for the lower high. Secondly, we have the somewhat untested short medium moving average, currently at 682.75, racing up to supposedly support the market. This can be seen as a possible balancing bullish influence. Thus overall, we have not really added nor taken away anything this week. Thank you for listening. This weekly broadcast gives essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright Eddie Tofpik and ADM Investor Service International Limited. And here comes the final bit.